Good morning, everybody, and welcome to another Mortgage Coach Tuesday interview. Every Tuesday, we are bringing advice, inspiration, and today is a very special call. I am collaborating with a special guest that I have not been in a venue like this for over a decade, but someone I've known for 2 decades and learned a lot from and collaborated a lot with. To help run today's call, I've got my co-host, Todd Bookspin. What's up, brother?
Hey, not much. I'm super excited to be here on a Tuesday with you and really excited to get to know the other Todd, the special guest Todd, because like you, back when I was doing loans, a decade ago, I just knew that Todd's content was amazing. And I know that he piqued a lot of people's interest in the mortgage community with his post last week. And I'm excited to be here to help everyone make what Todd teaches us actionable.
Right on. And I do want to let everyone know Todd is going to be taking over the Friday Mastermind this coming Friday and the following Friday. I'm taking a personal vacation. He has already confirmed Steve Sims this Friday. So book your calendar. It's going to be an action-packed Tuesday or Friday. And then also next Tuesday, I'll still be on vacation and Dan Keller is going to be taking over the Mortgage Coach channel. So stay tuned for who the guest that Dan is going to be inviting, but mark your calendar. You'll get some great leadership and it won't be from me. So before we bring on the special guest today, Todd Ballenger, let's welcome a couple mortgage coaches and not just average mortgage coaches. These guys have gone past black belt. They're grandmasters. They've both done over 1,000 TCAs, total cost analysis. And they define what it means to be a mortgage advisor. They care about their clients and they go beyond the transaction. It's not about, hey, here's a fee worksheet, your rate, your payment, your cash to close. They're about giving mortgage advice. And they're also both in the process of becoming certified liability advisors, which you're going to learn what that means and how that can be valuable to you. So Walt, thanks for making time to give back to this community, brother.
Thanks, bud. Honored to be here.
Yeah, Walt, you do a lot of things that I think are super smart. The way you're using social media to position yourself in your local market. I do believe you're working with Deborah Bird. Is that right? And social.
That is correct. She knocks it out of the park for me.
Yeah. No. And you're also part of the American Dream Network. So every time I turn around, are you the most well-known loan officer in your market yet? I mean, if you're not, you seem like you're on your way.
Trying to be. Getting close.
Good. Well, I'm looking forward to hearing what you're doing to become a liability advisor. And then Sosi Avala, what's up, my brother? It's always good to have you in the community.
Hey guys, good morning. Good to be here.
So Sosi, I've interviewed Sosi a number of times. If you like his energy, which I do, he's a guy you want to learn from. You can go into the Mortgage Coach YouTube channel, search by his name, and guys, I would just watch every interview I've ever done with this guy. I mean, he defines the next generation mortgage leader. And Sosi, are you pumped about taking it to the next level and becoming a certified liability advisor?
Oh, heck yeah. I'm so excited to be here with Todd. I've been listening to him for the last few weeks. So it's great to be able to meet a micro celebrity here face to face now.
Micro celebrity. I like that. Well, I want to be a macro celebrity. Exactly. I'm working on going from micro to macro.
I'm happy with any version of celebrity.
All right, guys. So let's bring in the guest of the day. I've known Todd for over 2 decades. We've both been mortgage nerds since we met each other. I met Todd early when I founded Mortgage Coach over 20 years ago. Him and I have collaborated on projects. We became competitors for a period of time, but I've always liked him. I've always respected him. To me, he's always been the professor, although he made that official a few years back, and he's actually on the staff and a professor at North Carolina University. And Todd, what are you doing at North Carolina? What kinds of teaching and training are you doing there?
Yeah, so we do a little work at the business school. We've done some teaching there. Right now, we're developing a program for the University of North Carolina that helps a student to sort of develop over their 4 years, so that when they graduate, they don't have just a degree. They have a really good handle on what it's like to live. Everything from career to money and finance to just developing a little co-curricular, masters in business and living. So it's a lot of fun. It's an ongoing course. We have about 2,000 students that'll take versions of that class in the next year, and then we hope to scale it up over time.
Well, that's something you and I have talked about for a long time, and we've had a passion now for 2 decades to elevate the mortgage industry so that a loan officer is more than a transaction fee worksheet LO. But we've also talked about how cool it would be to bring fiscal literacy to kids, maybe starting in grade school, high school, and obviously in college. So I'd love to collaborate more about that. And if you are a mortgage coach and you're in this community and you're doing anything to train college, high school kids about fiscal literacy, I would love to know about that, because that is a passion project of mine, and I like to shine a light on stuff like that. So Todd, like, this is the kickoff of our call it next level of our collaboration, our relationship, and we've recently rolled out the debt consolidation analysis within Mortgage Coach. And I've always been very passionate about loan officers need to be more than loan officers. They need to be mortgage advisors. And at Mortgage Coach, we think you can give advice, but if you're not a mortgage coach, if you're not giving a total cost analysis, you're just not the best mortgage advisor. Like the best, the top of the mountain as a mortgage advisor is a mortgage coach. So let's, if you could just walk us through the journey from your perspective. What's the difference between a loan officer and a mortgage advisor? And what's the difference between a mortgage advisor and a liability advisor?
Cool. Yeah. When we started, so this whole thing started out as an internal designation course. We had about 128 loan officers that spanned 7 states. And we were a new mortgage company at the time. This is back in the 90s, before there was a T in mortgage. And in that process of starting to develop our people internally, I felt like we were all salespeople. We were just selling product, and there weren't a lot of products at the time. It was a 30 and a 15, and this was when ARMs were first starting to get out. We were still typing mortgage applications, but I had come out of the financial advising space. So I was a financial advisor, had all my securities licenses, and had worked in that capacity. We crossed the balance sheet by mistake. I'd like to say by mistake, because we realized that we could have a bigger impact on people's wealth creation because they were spending more money on their liabilities than they were trying to save for a future. So we literally made a conscious decision to cross the balance sheet as a company. That's how our mortgage company started. It was a financial planning company. It became a mortgage company. And we started recruiting loan officers that sort of shared an interest in going beyond just selling products. So I traditionally think of a mortgage lender as someone who sells a mortgage product. A mortgage advisor is someone who starts to go beyond selling the product to really understand the products themselves, the impact on wealth over time, right? One of the core concepts that we try to explain early on is that you're always either a borrower or a lender your entire life, right? If you need money now that you don't have, you're going to borrow. If you have money now that you don't need, you can lend it. When you buy a stock, when you invest, when you're lending your money to someone else for a return. When you borrow money from someone, $1, right, you're paying what they call a rate, but that rate is their return, right? And when you lend your money to a stock or buy something, you're earning a return, but that cost might be a rate that they're paying. So it was just a mindset shift to say, look, you got to learn to borrow and lend. That's critical. And a mortgage advisor starts to learn, what it means and what the impact is on the role that they can play. And then for us, it just started to evolve. And then liability advisor was going beyond just the mortgage and saying people had they had equity lines which were tied to the house, but they had credit card debt, they had car loans, they had student loans, they had all of these other liabilities. And these liabilities were the primary friction between them oftentimes having more money than month. There's a common problem in the United States. People have more month than money, meaning what? They have to borrow to make up the gap. And that really gets them into a problem because now they're dealing with a hurdle of rate that they're paying on credit cards and stuff. So once you have more money than month, you get to play a new game. You get to start investing. So if we could drop this friction point, help them manage these liabilities, reduce that total cost, right, of this rate, then they had more money to invest. And so then we got into what we started calling certified liability advisors. And that was where we were trying to teach a level of mastery that matched up with a financial advisor. In other words, how do we take the best practices from the financial planning industry, which I came out of, and apply that to a mortgage lender? And that's doing presentations. It's collecting information. It's doing an advice-based conversation. And then what we realized is by doing that, we became very attractive to financial advisors. And then sort of the rest was history. We started building relationships with financial advisors, and that led to large contractual opportunities with Schwab, Ameriprise, AIG. So again, it just kept building. So it was kind of a single step to focus differently, but this is over 7 to 10 years, it transformed our business. So we used to like to say, if you can do billions of dollars, we helped Ameriprise build a $3 billion lending business from scratch using these concepts. You can build a very nice business just going out and differentiating yourself with customers and then ultimately starting to work with financial advisors. So long-winded answer, but a lot of stuff kind of evolved.
No, there's a lot to unpack there, and there's just a massive opportunity. And what I believe, we are at an interesting place in the world. Kristen Messerly and I are releasing a new article soon, and we're talking about the digital age that we're in, this digital shift era is what we're actually calling it. And I do think as mortgage professionals, you guys are local mortgage professionals, you need to look at your career differently. You know, real estate is being disrupted. You know, while I still believe for a long time to come, realtors are the alpha referral partner. But guys, there's other referral partners. Check out these stats. And these are Google. These are just things before the call I researched. The numbers may not be perfect, but Google it yourself. There are 654,000, almost a million CPAs. There's 311,000 financial advisors, 80,000 of which are CFPBs. CFPBs. There's certified financial planners. There's over 1.2 million life insurance agents. There's a whole lot of folks that are managing and helping families manage assets. But guys, I think when it comes to mortgage professionals, while I know there's over 300,000 that are licensed, but I'm talking about referral-based, advice-based, professional mortgage advisors, maybe 150, maybe 100,000. And here's the deal, guys. While there are, let's see how many homeowners, 80 million homeowners, 62% of them have a mortgage. So there's a whole lot of mortgages out there. There are 113 million open home loan, or not home loans, but auto loans. There are 191 million Americans have credit cards. 45 million Americans have student loans. Guys, there's a lot of opportunities out there. And when I poll average loan officers, I say, hey, how many debt consol loans are you doing? How often are you helping people optimize their liabilities? The answers range from not enough, hardly ever. I have reached out to a few folks that are saying, hey, we're doing a lot of them, but I think most loan officers are completely missing the boat on advisors. They don't have enough advisors as referral partners, and they're completely missing the boat on delivering a client for life mortgage practice. Because if you are not asking your client questions, looking at their full pictures of liabilities, and then recommending suggestions, start looking at, hey, should they move up? Should they invest in real estate? Should they consolidate some debt and do a home improvement loan? There's a lot of different directions they can go, but I think we're at a point where we need to make a shift, mortgage professionals. We need to elevate. Every loan officer who's local needs to be a mortgage coach / mortgage advisor. I think that's table stakes to be in the business. Like being a transaction-oriented loan officer, its time has come. And I do think a lot of you should become liability advisors. Todd, any thoughts on those numbers? And if I got any of them wrong, I know I kind of butchered them as I was reading them. But anything you want to comment on that?
Yeah, no, I could talk about that for hours, but there is a multiple number. If you look at realtors, and you think about a life event where a realtor would be in a position as an alpha referred or refer to you. It's a person buying a house and needing a mortgage. That's your window of opportunity, right? For a purchase transaction. Most of the loan officers I know with a refinance, that comes from their existing customer base primarily. With a financial advisor, financial advisors are event driven, and there are key critical events over the lifetime that trigger what you'd call a whole opportunity for them to do what they do. It's first job, first home, marriage, new job, new child, empty nest, pre-retirement, retirement, gifting strategies, trading down assets, building wealth. They climb a mountain building wealth, and then the new part of their job starts where they're now having to manage the distribution of that wealth once someone actually retires, because then the money's coming out versus going in. All of these events are happening. And if you understand that industry based on assets and things, they're critical and they're required touch points. So a realtor is going to complete a transaction and they're moved into the next. The advisor has a long-term relationship. Oftentimes they're meeting once a quarter with that client, and each time they can farm and mine for opportunities. So it's not just the sheer number of them, because there's so many, it's the frequency of interaction that they have with their clients compared to the realtor, that if you can build a relationship, you're literally guaranteed to touch those clients, all of those clients, through that advisor on an annual basis. And that dramatically changes your business from rate driven, right, to event driven. And we used to say event driven business management starts to look like this. Rate driven is like this. And what I mean by that is a financial advisor has a client who's getting a divorce, and one wants the house and another one doesn't. They refer that client to you. That had nothing to do with interest rates, right? A kid's going to college and they need access equity in the house and consolidate debt for college planning. There's nothing to do with rates. All of these event-driven things are not rate sensitive. And if you can get 30 to 50% of your business coming in from advisors, you've just removed the volatility of your business dramatically. And so you've got a lot of people, it's event-driven. It can have a profound impact. And again, the average mortgage sizes are higher because people that have financial advisors tend to be wealthier. There's just a lot of real benefits to that population.
So a couple of things. So also, guys, if you have a really healthy liability advisor platform, and you have a number of referral partners that are asset advisors, insurance agents, you are more valuable to the alpha partner, to the real estate agent, because they're getting disrupted. And so you become ultimately the dream, the captain of the wealth team. And that's what families need. They need an advisor that is that captain of the wealth team, that's helping them build wealth with real estate, helping them manage their liabilities, helping them manage their assets. And you can become the captain of that team. But you know what? Here's the deal, guys. You can't be the captain of the team if you're a fee worksheet loan officer. You can't be the captain of the team if you're not a black belt mortgage coach. And what I'm really gonna, I think the punchline to this call today is you can't be the ultimate captain of that team if you're not a certified liability advisor. So before we bring in two loan officers from the streets, both top producers that are on that journey right now of going from, I'm a mortgage coach, I'm a red belt, I've done this thousands of times, to I want to be even more valuable to consumers. Todd, any thoughts or any questions you have before we bring Sosie and Walt on stage?
Go ahead.
Todd Bookspan. Sorry.
Yeah.
I got two Todds. I can't even say Todd B. I got to say, it's going to be Bookspan and Ballenger from here on out, guys.
Yeah, Todd B won't work.
Well, I mean, I just love the idea, Todd, of the whole idea of rate driven versus event driven. And so as I'm sitting here listening, if I'm putting my loan officer hat on, I got to feel like that is a huge opportunity. As you said, they're less rate sensitive. And certainly I would encourage anyone who didn't watch last Friday's Mortgage Coach Productivity Mastermind call that Dave and I did with regards to the new debt consolidation tool. It's a must have since we had Jacob Gibbs on from Mortgage Coach, who walked everyone through how to do it. And so that's a must watch. What do you feel, Todd, are the top one or two things that a loan officer can do in order to get in with an advisor quickly?
So there are three primary advisory groups that you want to understand. The first is what we call the agent group. That's life insurance agents. That's your state farms, your homeowners insurance type. That's the agent. The secondary group is what we call the accounting group, and that's anyone that's an enrolled agent, a CPA, or someone in the bookkeeping or professional accounting services. And the third group is your traditional advisor, and there's CFPs, there are chartered financial advisors, there are wirehouse advisors, and they're financial consultants. So as you start this process, I encourage people to learn this business in that order, because what you have to really understand is how they manage risk and what their motivation is. And the agents are always looking for premium, which is a function of cash flow, to be able to sell the products and services. So when you partner with life agents, you're really learning how to partner together to find cash flow. That can be refinancing, it can be debt consolidation is a big way that you can free up cash flow. And it's a very simple relationship. It's very transactional. I've got a customer, I need your help. I need to find $200 a month. I mean, so it's a way to sort of build that relationship. And there's, in each of the insurance groups, there's all the way up to $1 million round table. So you'll find that there's stratas of agent and capacity within those groups. But start there with agents and then work your way into the enrolled agents and financial. In each of them, there's a different strategy for how you want to do that. It's the same, but it's different because you're learning how they make money. This, the hip mind nerve, how people get paid is critical. And so you're having to learn about, where do they shop? What do they like to eat? And I'm joking, but you want to understand the persona of those particular groups and master the agent and working with them, then master the enrolled agent and then ultimately master the financial advisor. I find a lot of people, they try to call a Merrill Lynch advisor and build a relationship. They don't understand those guys and gals are compensated, and they have on-book ways to work with their clients through existing relationships. It takes a higher level of mastery to win that over. And that's now you're having to overcome their own internal compensation because your value proposition is just unbeatable. And you can do that, but it just takes, again, a higher and higher level of skill. So start with your New York Lifes, your local State Farm people, things like that. Go grab lunch with them, talk to them, and you'll be surprised at how quickly they're willing to start working with you.
So guys, this is really the beginning of a conversation, with the rolling out of the debt consolidation analysis at Mortgage Coach, which we've been doing for a long time. It's part of a bigger strategy for mortgage coaching, help families build wealth with real estate by managing all of their liabilities and their equity, empowering you as a mortgage professional to be that captain of the wealth team. That's what we're all about here. So let's bring a couple of loan officers in. Let's find out a little bit about their why. Remember, guys, this is a mastermind. So if you have questions and you're watching this live right now, whether you're in Zoom or whether you're in Facebook, put your questions and comments. We will get to them. And if you're listening to the recording of this, Todd will be back on this stage. Todd will be active in the Mortgage Coach Facebook group. And so he's available. Ask questions as they come up. So Sosi, let's go first with you, brother. I'm going to do this two parts. Anything you want to comment around what's already been said, but I really want to net out, why are you investing your time and energy to become a certified liability advisor?
Yeah, thank you. I had a quick question for Todd. Todd, speaking of, it's funny. Todd's question to Todd sparked me to have another question for Todd. And what that is in regards to finding the right financial advisors. A lot of times when I cross-sell my financial advisors to the client, I'll let them know that my experience has shown me that a lot of financial advisors are either overpaid stockbrokers or really good life insurance salesmen. They're not really good at making a financial plan for someone to actually reach financial freedom. And so the thing I would want to make sure I know how to avoid is how to avoid those bad financial advisors that I don't want to work with.
Mm-hmm. Yeah. So when you start understanding sort of the stratas within each of those three groups, like a CFP, a chartered financial, planner, professional, is going to be at a whole different level. An RIA, a registered investment advisor, they're like the Navy SEALs of the financial planning industry. They have the same licenses, but they operate independently. They regulate themselves because they have the ability to do that. You'll start to be able to spot instantaneously whether you're dealing with a financial salesperson, right? And don't get me wrong, they are incredible referral sources. We had a an annuity sales rep for TIA Craft that was going into schools and meeting with school teachers. And when he understood what we did, he had our form and he would fill it out with every client and send it to us. And in a given day, he was meeting with 10 to 15 teachers. We would get 10 to 15 sheets a day from him on what about this and what about this and what about this one. And they were just simple. And 2 or 3 or 4 in that group always had an opportunity to refinance or consolidate debt or those kinds of things. So you're really looking for a chemistry or a kinship in being able to say, how would I work with this person? A financial advisory firm is going to ask you to do a plan, create that TCA, do the debt consolidation, send it back to match up with what they're doing because they're meeting on a quarterly basis to do reviews. Insurance agents, those cats, they're just going to say, can you find some cash flow for me on this particular situation? And you'll start to find a rhythm. I loved insurance agents because they were so simple, right? I've had a border collie, I've had a lab. They're very different dogs. They both have their charm, but the agents of the world are kind of like the labs, right? They're just find me some cash flow, right? The border collies, you got to work with them, man. They're intense, they're focused, and so they're whole different kinds of relationships that come out of these things. CPAs, again, completely different. They're fee-based. They're going to find ways to bill hours for your time, and that creates a new channel of opportunity for them. And we teach all this. We kind of explain each of these different groups and how you work with them differently and how you build those relationships because they're built over time. Trust is built, based on a series of promises kept over time. But once you start working with them and they see what you can do for them, you'll disintermediate anybody else that they've referred to in the past.
Love that. Thank you. That's helpful.
So Sosi, what is your why? Why are you investing time and energy and capital to educate yourself and get into being something more than a loan officer?
I'd love to say it's because I'm bored and I need good entertainment, but time is not one of those currencies that I have a lot of. So on my end, I think the best way to share it is to share a scenario that happened to me about 3 weeks ago. And it's a client that when I first met him, we were connected through the realtor for a refi. And when I met him, I think it was about 3 years ago, the refi didn't make sense. What he was looking at doing just wasn't going to save him the money he was looking at saving. In the long run, it wasn't going to save. And we just said, look, here's the refi option you want. Here are the pros, cons. What do you want to do? No? Okay, great. Let's go into other aspects of life. Have you created an estate plan? Have you spoken to a financial advisor? And we started talking through all these things, and it sparked us to be able to identify he had a lot of risk, so much so that he still had a father who had some potential of coming over and trying to take his home if he would have ever died. And so all that really made him understand that there is so much more that he didn't know that he needed to. And fast forward about a year and a half or so, and we ended up looking at a scenario again, and a refi made sense, but now his real goal was to buy a new home. So we ended up setting him up to be able to sell, pay off debts. He had a loan that he took out on a second mortgage to help mom out with some things, paid that off, moved over into the new house, was in a new build, was beautiful, perfect, all that great stuff, right? Then we refinanced him again into a better monthly payment, took off the mortgage insurance. I mean, he was stoked. His savings were where he wanted it to be. And a few weeks ago, I get a phone call from him. And he's telling me, hey, Sosi, I'd like to do a Zoom. I really want to share something with you. I thought the guy got engaged. I mean, it's really neat to make personal relationships with clients and to see them want to share those exciting milestones in life. And so I was thinking, okay, cool. He finally got engaged. It's going to be really cool to celebrate with him. I'm a little busy this Saturday, but you know what? For the sake of the relationship, I better jump on here because I really do like him. And when we got on there, he shared something with me that I was not foreseeing. He let me know that he wanted to make sure I understood how much of an impact I had on his life and how, because of the guidance we gave him and the ability to expose himself into an understanding that he didn't have. And mind you, he's a counselor at a high school trying to help students be in a better place. He's a big brother. He has this huge heart. He shared that after he got all his own personal finances in order, speaking with the right professionals we connected him with, that he was able to create a plan where he contacted his alumni and he set up a sponsorship program where he was going to be setting up funds with a few other friends as well to support somebody in Nashville going to the college he went to, who's being proactive in the community so that he and all the funds they're putting there can help that person through school. And he goes, I just want you to know, not only did you impact my life, not only did you set me up so that I can be in a good position, but what you did and the advice you gave me has now changed the lives and potentially changed the lives of the person we're going to help for all time. And he goes, I just want you to know that this sponsorship is because of you. That was amazing. And that made me just want to be driven in identifying more of this stuff that we weren't taught in school. Right? Like, what is a full life insurance policy? How do I use that to be able to grow my wealth? What's an estate plan to the very T? What do I need to have in there? And so for me, the reason I wanted to make sure to carve out time in my schedule to be able to learn from Todd was because he obviously has a proven system that has created a lot of success for him and the families he served. And I want to just ride on those coattails and learn how to be able to do that at a greater degree as well.
Love that. So life-changing impact. You wanted to create more impact. And I find when I interview top producers, they love helping people. They love creating lasting impact. And when I interview loan officers that have usually gone from that fee worksheet loan officer to that mortgage coach, that certified advisor, it's to create more impact. And now as a result of that, guys, remember, you get more loans and you get more incremental loans. That means, once you learn how to be a liability advisor, you can look at almost anyone's assets and liabilities and restructure them in a way that achieves their goals faster and more effectively. And of course, if you're a mortgage coach, you can visualize that to a family more rapidly and more clearly. Before we bring Walt on stage, Todd, any impressions you have there? Anything you want to ask or say?
Just that,
Ballenger.
Yeah, Sosie's right on there. One of the things that it's probably an incredible benefit is not just you'll get more loans, but you'll create your own mastery of your own financial well-being that's really, really different. It's like when you really start looking at this stuff for clients, you're in a really unique position. You get to look at people's financial lives in a balance sheet every single day to see the decisions that they've made or not made. And in that process, as you get better and better at it, you really become, as Dave says, a black belt. You start to immediately see opportunities that would have never occurred to them. And I'll tell you, it would often not occur to a financial advisor. One of the first things you have to realize is financial advisors, when they build relationships, they don't get what you get. They get, I've got a $35,000 IRA. What would you do with it? Have you ever had that conversation with your brother? I've got 100,000 of 401k over here. I'm changing companies. What would you do with it? You get the whole kahuna. You get the whole assets and liabilities, that whole balance sheet up front. And that is like the keys to the kingdom. When financial advisors realize that, most of them don't understand that. They're like floored because they have to give you that because they want to borrow from you. It's a condition. You see, you guys live in a world of suitability, which is, can this person borrow or not? The financial advisor lives in a world of eligibility. So they're always eligible to make an investment, right? And so, I'm sorry, you guys live in a world of eligibility. They live in a world of suitability, sorry. So, are they eligible to borrow, right? Is this suitable or not? The financial advisor is saying, okay, I could put them in oil and gas, but is that suitable? They're not thinking yes or no. You're in a yes or no business first and foremost. You can have such an incredible impact on the customer, but you'll have an impact on your own life when you really start to master these time value of monies, the rule of 72, the last double. They're simple concepts that, when you understand that when you start investing and developing wealth, everything compounds, including problems. So the longer you wait, the more those problems compound. The sooner you start, the more the wealth compounds. And so this becomes kind of part of who you are.
I love that. Everything compounds. So Walt, what is your why? Why are you going to the next level here?
For me, it's really being able to make an impact upon the client's life and make a lasting impact. I mean, first of all, Sosi knocked it out of the park with what he just talked about. I mean, that's huge, to be able to make that impact. And, you know, for me, it's the little wins. It's the wins that, I had a client come in that was referred in 2019 from a realtor, and and they came in and they wanted to refinance. I said, you know, what do we want to do? And they were 23 years into a mortgage. They said, we want to refinance into a 15-year. So I showed them what a 15-year would look like, and they just wanted to do that. That's really all they were in to do. And I said, you know, do you have just a minute? I just want to share with you one other idea, and you can take with it whatever you wish. And I'd asked them, you know, when do you plan on retiring? And they said about 7-8 years. I said, okay, great. So well, you have this debt right now. What if we include the debt in your refinance? And what if we pay that debt off and we take the savings on a monthly basis and apply that to the mortgage? So making the same payments that you are now, are you okay making the same payments that you are now? And they said, yeah, that'd be fine. And when I showed it on the TCA and then showed their freedom point, it was exactly at 7.5 years. So at 7.5 years, they could be completely debt free. And to watch them, to realize that was huge. It reminds me of a closing that I had years ago for a first-time home buyer. And it reminds me why I got in the business, where the wife at closing started to tear up and started to cry a little bit, and kind of scared me. And you know, the husband was a little shaken, and the escrow officer's looking at me and looking at the husband, and we're all looking at the husband, and the husband looks at the wife and said, you know, are you okay? And the wife said, yes, this is where we're going to raise our family. So being able to make an impact upon others' lives. And I think for us, for me specifically, I forget the impact that we make on others' lives. I forget the impact of helping them just buy their first house, just to be able to get into the house. You know, a client comes in and they don't know if they can get approved, and you know, they buy their first house, and then we continually work on them with mortgage reviews, and a few years later, now we help them save some money, and we can help them start to, you know, whether it's pay off debt, whether it's start to invest in, you know, life insurance or other ideas, or just help them increase on a monthly basis how much they're paying for their 401k, go up to the max 401k. So for me, it's really that feeling. It's the feeling that I'm making an impact upon others' lives, that I'm making a difference in others' lives, as others have for me.
Hey, Walt, before we go on to a story, and before this is over, Sosi, I do want to get a story from you. You were just describing a family that you served. Is that the total cost analysis you have right now that you could just show real quick? Because I at least want people to connect the dots on how you're able to present this to a family. If it is, could you share that on your screen real quick? And I just want to spend a minute or two going through it, guys, because there's so much to be learned here, and there's so much value here. I mean, you need to know how to ask the right questions to deliver the right advice. Is this the TCA that you just described?
This is not. No, this is the one that that I just made up. You know, honestly, I've got to share something. I probably, you know, anyway, I didn't know about the debt consolidation tool that Mortgage Coach had until you brought it forth to me. I'm a little behind in my videos, so I appreciate, you know, it's kind of trial by fire, right? So I appreciate the opportunity to learn about that. So this is one that I just made up. Traditional, you know, current mortgage here, they're at 1995, 4.25% interest rate, loan amounts 301. You know, they come in for a refinance. We drop them down to 3% to a 1310 payment. They're saving a considerable amount of money. I always give options. And so option one would be to pay off their house early at 21 years, accelerating their payment on a monthly basis to pay off early. Second one is to pay off consumer debt. That interest rate's going to, of course, be a little bit higher because it's a cash out refinance and their payment goes up, but then they can take that money and again, accelerate their payment and get out of debt quicker. So, or the other idea, which is really the one thing that I share with people, is the Rule 72. And Todd Ballenger, I don't know if I've dumbed it down enough for myself, but what I tell everybody is, you know, the Rule 72, I always ask them, the Rule 72, do you remember what it is? And I don't. And I just say, you know, basically your money's going to double depending upon what your interest rate is on average every 7 to 10 years in that ballpark. So if you can invest a lump sum, or if you can invest money, it's going to grow and double. And this one here, where we saved money on a monthly basis, we're taking that and it's $590. We're reinvesting that into the mortgage. And over a 10-year period, that grows to almost $100,000. The big thing with this is that as you're taking that money and you're paying off debt, take that money and then reinvest on a monthly basis with a financial planner, you know, at that point, you can have a freedom point that is much faster, which is 15.75 years, opposed to just trying to pay your mortgage down. So what I try to share is that really compounding money.
Real quick, well, before you pull that back up, because I just want to make sure we did a comprehensive training on this on Friday, but click on that debt consol on program 1, 2, 3, 4. Yeah. I just want to make sure, guys, you know, this feature is available in Mortgage Coach, where it really breaks down into detail, where you can toggle from short-term value to long-term value. One, to give you a breadcrumb there. So we have a comprehensive training program on this. You could go ahead and stop sharing. I just want to make sure people saw a breadcrumb to this particular part of the report.
You know, for me, and the thing that helps me stand out is that I'm sharing financial planning tools, you know, and strategies. I'm helping clients understand the compounding effects of money, opposed to amortizing money, and it works differently. Helping them understand that a mortgage can be a financial planning tool opposed to just a debt at best. So you know, I had gone through, at that time it was Borrow Smart, Retire Rich, in 2008. And then of course, 2009, 10, 11 happened and I just forgot everything. So, you know, I'm honored to go through it again. And I'm relearning those things. And I had a pretty good, I felt I had a pretty decent client presentation. And now I'm revamping it, introducing a lot of those ideas back in with the client to help them understand the value that we bring. It's much more than just a rate consultation. And that client that I shared with you that ended up wanting to retire, and we were able to create a financial plan for them that they could do it in 7.5 years and be completely debt free. I mean, when they both looked at each other, it was just like the light bulb went off, and they both realized they were hard workers. They were laborers, both hard workers, and they both realized we can actually retire in 7.5 years and doing the same thing that we're doing right now, the exact same thing. That's where I feel fulfillment in my life.
Love it. Well, guys, we've only got about a little over 15 minutes left. I want to make sure Sosie gets to share a story, but Todd, I want to give you, Ballenger, give you a chance. Any comments to that or any questions?
Yeah, yes, so many, but you know, Walt's journey, and I'll give you a thought that if you'll think this one thought about what you do, it can be very pivotal in the way you start to position yourself internally, externally, et cetera. And that is, financial advisors manage assets. And the key criteria that they use, if you've heard of this, is assets under management. So, you know, if they're an insurance agent, they're not focusing on that. But when you get into the financial advisory world, do I have $1 billion in assets under management? Do I have 200 million? I want you to think of your business as liabilities under management. And liabilities under management is the total volume that you've closed in your lifetime. So if you've closed 200 million, $300 million in business, those are your liabilities that are under management. That's your portfolio of your book of business that you've had an impact on. And again, the compounding impact is phenomenal. But if you start thinking that way, the way Walt's talking about and Sosie's talking about here with those customers, you're starting to think about the impact that you're having over an extended period of time. It costs extra to live indoors. Would everyone agree, right? And that means, that when you move out of your parents' house and you start living indoors, that payment is going to come until you die. That could be 60, 70, 80 years. So you think about the rule of 72. How many doubles is that? That's 10, 12 doubles. So think of yourself as in the liabilities under management business, and you'll start to think more like the financial advisor does. Every new customer, every time you take another transaction in, you're building that book of liabilities that are under your management, and the impact that you have is going to continue to compound and grow.
Love that analogy. And a lot of loan officers talk about how many families, how many loans they have under management. And part of becoming a liability manager is to take that one step further.
Yep.
How many liabilities do you have under management? And then how are you systematically and consistently delivering services to make sure you're optimizing the equity and the liabilities for that family to make wealth faster? So Sosie, any stories you want to share, any TCAs you want to share before we go into a wrap-up mode? You got about 5 minutes.
Sweet. I will speak quickly. One thing I will throw out there that I think might just be helpful, especially for hearers, is to even, all of us, I think, would confess this. Not all loan officers are mortgage advisors, and not all mortgage advisors are actual mortgage advisors, right? There's some who use mortgage advisory as a sales tactic. And honestly, on my end, there's no judgment, right? Like, there's so many ways to be successful in this industry. If your goal is just to crank out numbers, you can look at this and put this in your sales conversation, and you can produce a lot more. If your goal is to truly impact people and most of all the legacies those individuals leave, then this is the thing that makes you go to bed at night really, really well, right? I would just say, if you're listening to this, make sure that you're asking yourself, what do I really want to utilize? And for me, I'm going to use a word that, because of the pastoral background, it really drives a conviction for me. What do you really want this vocation to be like for you? Right? And so the vocation term is this means of ministering on this planet. Some people minister at a ministry church, and some people minister through their regular vocations like mortgage advisory. And so for me, that's what really drives. And the thing I would kind of put into perspective here is, as you're answering that question for yourself, also make sure you're answering, where do I think my business is going to be in 5-7 years? Right? I've had some older loan officers tell me, hey, you know too much. Right? And it's like, yeah, but that's my generation. We're going to know a lot more because there's a lot more knowledge for us to draw from. It's called the internet. Right? And so in 5 to 7 years, when you're looking at what's growing traction on YouTube channels, when you're looking at what memes are becoming popular, and this next generation of buyers reaching the age of 32, you're seeing a lot of exposed to knowledge individuals. And so for us, we got to take this knowledge and decide, how do we want to use this to help others? And when you actually know what Google leaves them as a dead end at, and then can take them further, gosh, you're the winner there. And so again, as you answer this question for yourself, ask yourself as well, where do I want to be in 5 years? Do I want to be the one that's just racing to the bottom of the price sheet because that's the only way I can survive because I got no other value? Or do I want to be the one that people come to because they know I'll give fair pricing and I'll help them be in a place in life no one else could ever put them in? And so with that said, I'll share one story, and it's not going to be as deep on the debt consolidation as I would like at the moment, just because I'm still trying to cut my teeth on this. But in the vision of trying to help clients think through things differently, right? Especially in light of our financial advisor partners. I had a client come up, and she was referred by another past client. Very high D, lots of energy, knows what she wants, high executive in her firm. And she wanted to look at a 15 or a 10-year refi. And she was like, I just want to look at what these are and what that could do for me, because I just want to be done with this loan as fast as possible. Okay, great. And then I asked her about her goals, and she didn't want to be in this home that long. So it's like, okay, I don't know why you want to, but okay, cool. We'll just humor this, right? Because No one's going to convince you otherwise because you're just not going to be convinced. But at the same time, there's a lot of help that you need to leave yourself open to just in case life does change. And so I showed her what the 15-year looked like. I showed her what the 10-year looked like. And I showed her that if she took a 15-year loan and paid the same payment as the 10-year, she would pay the 15-year in 10.8 years. And she was stoked on that. Right. And so when I saw her excitement of, okay, so you're telling me I can still hit my goal of feeling responsible and paying my loan off quickly and have the flexibility that if I have a hard month or if I need to help family, I still have the funds I can use, that 855 difference of payment, and use for whatever I want. Yes. So you have freedom and active responsibility to make sure you're doing what you're supposed to be doing. Awesome. But let's look at another option to it. Let's look at the diversified 15-year. So let's say you did a 15-year loan, and instead of using 855 for a reduction payment, use 855 in an investment account. And let's pretend nothing is in there right now. And I believe, let me look at what rate of return I used on this guy, 6%. Right? Let's say you used a 6% return. When you compare how fast you would pay off your loan in regards to just adding reduction payment to your principal, or being connected with a really good financial advisor who's more than a life insurance agent, who's more than a stockbroker, one who can actually put you into an account that's going to help you save faster. Option B, by the time you have the same amount of money in your investment account as you would in your loan balance, you'd be able to see those two things marry each other at 9.5 years. So not only can you have the freedom to pay your payment or not pay your payment at the higher 10-year, but you can also have the resource that if life changes and you decide to use this as a rental, you don't have this overwhelming monthly payment you have to try to cover. If life changes and you find that guy that you want to spend the rest of your life with now because you're in that stage of life where you just want to pick up and go and enjoy your retirement more, you have all this liquidity, not frozen money you can tap into to live the life you want to live. And so when we did that, it was done. Right. And so she's already connected with the financial advisor. We already closed on the loan. It was a fantastic process. And it was really great to be able to show her a thought process that she's never been exposed to and see that help her see better options.
Love that, Sosi. So Mortgage Coach, one of the things we're going to do more often, we already do black belt training every Wednesday at 11 o'clock. I've got a success manager that is teaching how to be a mortgage coach black belt. And it's designated group coaching and training for that. With Todd Ballenger and myself and other people in the community, we're going to do more just case studies where Sosi comes, he said, I had a family. This is what their balance sheet looked like. This is what their goals were. This is what I provided. And myself or Todd or another certified liability advisor will go, hey, did you think about this? Did you think about that? And we're going to be doing some training on how to be a certified liability advisor with Mortgage Coach. And to be a mortgage coach, you just need to do hundreds of TCAs where you've helped family look at different mortgages and compare them. To be a mortgage coach, a mortgage coach, liability advisor, you need to do, 20 debt consolidation analysis. You're there. But guys, one of the things that I want to talk about is being a certified liability advisor, where you can sit knee to knee with a financial advisor and be a peer. You can help analyze both the assets, the equity, and the liabilities for someone. So Todd, could you just give folks, one, if they wanted to get into your community, become a certified liability advisor, one, what that looks like, two, how can they get signed up? Would you just give us a little high level overview on that?
Sure. Yeah. You can go to barsmartuniversity.com and you can learn about the course that we've developed. It's a web-based course, so you can take your time with it. We teach it live over many days. And as Sosi said, and Malt said, a lot has changed in the last few years. So now you can sort of take it the way they're taking it at their own pace. We have a really cool community of people that have been through the information in the past that communicate, collaborate, share ideas, and we're going to bring most of that now into the mortgage coach world. So that's going to be a lot of fun for you to learn from them. And it's about 30 hours, give or take, of content, but a lot of resources, a lot of thought patterning to get you thinking. When you sit down knee to knee with a financial advisor, you say, I've got about 280 million in liabilities under management. you just started the conversation in a totally unusual way. And they're like, what do you mean? You know, because I have 300 million in assets under management. So it's learning to talk, it's learning to position. If you just do it for yourself, you'll learn a lot about your own capacity and capability to manage your own assets and liabilities in a more effective way. But then you'll be able to take that to your clients and then ultimately out and become very proficient in building and developing a totally new network of referral business. I really, as Dave said at the beginning, the real estate agent is a target, a hard target. I have some rental properties and OfferPad is trying to get me to sell them and they're making compelling offers. And I'm just not seeing realtors in the position they used to be in, with Zillow and the things that are happening out there. Financial advisors already been disintermediated from a robo-advice standpoint, but they've made their stand. They've come back quite strong in what they're doing. And I think they're going to be in a position to really refer in the future. So, learn to do it for yourself, learn to do it for your customers, and then you can monetize in some really cool ways by learning to do it with the community of agents, accounting professionals, and then financial advisors.
So if someone wanted to sign up, you gave them the link. I know you're giving a discount to the mortgage coach community. Could you let them know what the price is and what the mortgage coach community discount is?
Yeah, so it's $14.99 for the entire course and the certification and all the materials, and we're giving a $500 discount right now to mortgage coach members, so you can get the entire course for $9.99.
Yeah, and you just need to put in the discount code. I know it has MC in it, but what's the full discount code?
Oh shoot, we'll have to look at. Yeah, that's a good question. I'd give it to you, but I might give you the wrong one.
Is it VIP? MC VIP?
Yeah, that's it. Yep, that's it. MC VIP. Yeah, MC.
All right, guys, we're gonna put a link down below. So if you're in Zoom, there's a link in chat. If you're watching this in Facebook, there's a link in comments. And if you're watching this in YouTube, there'll be a link to the TCAs that were shared. So you can look at those as training resources, and there'll also be a link and direction to get signed up for this. It's something I endorse. I think it will make you a better mortgage professional. I think it will make your job more fun. That's the thing I think people often forget. It's like, hey, you're giving more impact to the people that you serve, but it's more fun. It's more satisfying, and you get incremental loans. And you now can have some referral sources other than the alpha realtors, which makes you more valuable to agents. So Mr. Bookspan, Mr. Win by Noon, Mr. Coach, what are some of your takeaways and what is your advice to anyone listening to today's call?
Of course, my advice is to sign up for, under $1,000, nice discount. Thanks, Todd, for helping out our community. There's no doubt that we all can take our business to the next level. And there's definitely lots of studying you can do. There's hours and hours of video here in the Mortgage Coach YouTube channel that'll make you better. But this is certainly a great opportunity for you to learn from the best and just really take yourself up another level. I just love this whole idea of event-based versus rate-based refinancing to build your business. I love the idea of, moving money from, as Sosi said, to liquidity from being frozen, and this whole idea of liability asset management, right? You've got to do annual mortgage reviews. That's what you're claiming to be. And so be that advisor. You all have it in you. You can totally do it. And just another great call. I love Sosi, Walt, your stories. Thanks for adding those to the community, and really excited, Todd, to have you as part of this community. Like I said, a decade ago, I looked up to you, and now I get to learn a lot more and get to know you better.
Cool. Thanks.
Cool. We got a couple of quick questions. So someone asked, so to learn how to use the debt consolidation analysis, first of all, the last interview that we did on Wednesday, we covered it comprehensively. We did a training, 10-minute training within it. We gave links to a study guide, a training tool. Remember, guys, every Wednesday we do black belt training. And right now we're including debt consult in all those, Wednesday at 11. Every Thursday between 9 and 10, we do group training on our product, and the debt consult is covered. So there's multiple trainings, and there's a how-to video on how to do that. To be a certified liability advisor, that's a 30-hour, it's like college level course taught by a professor. I mean, we're talking about a guy who's a professor at the University of North Carolina. And so if you want to do that and go to the next level, it not only includes, it's not a how to use mortgage coach, although there is some strategy around mortgage coach, It's a how to be an advisor to a consumer, and it's how to turn that into a business value proposition and how to actually give referrals or get referrals from advisors. Hey, one question came in from Deborah Bird, who's a social media leader in our community. And she said, Todd, does it include actual scripts to specific, like if I'm talking to a CPA, does it tell me how to approach that CPA versus how to approach an agent?
Yeah, we walk through the strategies for each. For example, with the CPA, if they're hourly based, and then you want to think about providing a review service as part of the way they review. There's actually trimesters when the CPAs are extremely busy that you want to leave them alone. And there are times in the year when they have nothing going on that they're very open to these types of opportunities to create additional billable hours. So we're kind of going through, again, both how to do it, the psychology, and then the strategy, whether it be scripts or lunch and learns, which is a thing we talk about that we did very successfully with CPA and financial advisory firms. And it was this is a question that comes up a lot. I saw it in the chat, and this is, do I need additional licenses to do this? And the answer is, it depends. And those two words are the most important words that you're going to learn as a liability advisor, because with most things, if someone says, should I get it 15-year fixed? Your answer should be, it depends, right? And then it depends on what is where the mastery is. And that's where, learning this stuff, you'll be able to answer that question. But unless you're selling the products for compensation, you do not need any additional licensing as a mortgage advisor or a liability advisor. You're just providing guidance and advice. You're licensed as a mortgage lender because you're paid for that. If you want to get paid to sell those products, you've got to get licensed. But if you're just giving advice, anyone can call themselves an advisor. The SEC says that. They don't have to have a license for that. The point where you give them a specific product, get RQI as a REIT for that 6% return, and you get paid for it, that's the point where you need to start thinking about having licensing.
Love that, Todd. Thank you for that quick answer on that. I was actually going to pull up that question. And guys, those are the kind of questions we want. We want to help you elevate to the next level. Hopefully, if a lot of folks from this community will sign up for this program, please keep me updated on your journey on it. We're going to be doing more calls around this. I am looking for success stories where you use Mortgage Coach, you use the functionality in Mortgage Coach, whether you use the debt consult functionality or not, but you used what was appropriate for the consumer. And then we're going to give you feedback. So if you have samples, you want to jump on and get better with Todd and I, Ballenger and I, let me know. So guys, this is a wrap. We appreciate everybody's time. Special thank you to Walt and Sosi. You guys make a living and get paid as loan officers. So thank you for giving back to this community and helping all the other loan officers and mortgage coaches get better, brothers. Take care, everybody. This call is a wrap.
Thanks,
See you all.
everyone.
Yeah. Thanks, everyone.